Hi, in the next few minutes, I will explain what business cycle and derivatives are. First of all, I would like to talk about business cycle that is basically defined in terms of period of expansion and recession. During expansion, the economy is growing in real terms, as evidenced by increases in indicators like employment, industrial production, sales, and personal income. But during recession, the economy is contracting as measured by the decreases in the above indicators. Expansion is measured from the trough of the previous business cycle to the peak of the current cycle, while recession is measured from the peak to the trough. Now, a downturn that lasts more than 6 months is called recession. But on the other hand, when the time lasts for about 1 year or 2 years is called depression or a slump. Eventually, the economy will bottom out and there will be a recovery or an upturn. Now, the balance of payment is a statement that summarizes an economy's transactions with the rest of the world for a specified period of time. The balance of payments, also known as balance of international payments, encompasses all transactions between a country's resident and its non-residents involving goods, services, and income, financial claims on and liabilities to the rest of the world, and transfers such as gifts. Now, about supply and demand. And when people are worried about the possibility of losing their jobs in the near future, they tend to start saving money and consuming less, which it leads to fall in the demand. And as soon as the demand stops growing, investment and new factories, machines, etc., falls, which contributes to the downturns. But if supply exceeds demand, prices should fall and encourage people to start buying again. Eventually, the economy will reach a trough or bottom out, and there will be a recovery or an upturn. For the last, the theory of the business cycle can be internal or endogenous or external or exogenous. About the derivative itself is merely a contract between two or more parties. Its value is determined by fluctuation in underlying assets. The most common underlying assets include stocks, bonds, commodities, currency, interest rates, and market indexes. Most derivatives are characterized by high leverage. Future contracts generally made on trading floor of a future exchange to buy or sell a particularly commodity or financial instrument at a predetermined price in the future. They are standardized to facilitate trading on a future exchange. Some future contracts may call for physical delivery of the asset, while others are settled in cash. It is well known that derivatives has a high doses of speculation. That this meaning is a risk of losing most of all initial outlay in expectation of substantial gain. With speculation, the risk of loss is more than offset by the possibility of a huge gain. But on the other hand, speculation has its benefits in a free economy by their willingness to assume the other side of the trade. Speculators provide market liquidity and narrow the bid-ask spread, enabling producers to hedge price risk. Speculative short selling may also keep rampant bullishness in check and prevent the formation of asset price bubble. Now, about the hedge is to make an investment to reduce the risk of adverse price movements in an asset. Normally, a hedge consists in taking an offsetting position in a related security such as future contracts. For example, of a hedge would be if you own a stock, then sold a future contract stating that you will sell your stock at a set price, therefore avoiding market fluctuation. An interest rate swaps is an agreement between two parties where one stream of future interest payment is exchanged for another based on a specified principal amount. For example, a company will use interest rates swaps to limit or manage exposure to fluctuations in interest rates or to obtain a marginally lower interest rate than it would have been able to get without the swap. It means that basically it's simply the exchange of one set of cash flows for another. Now, the currency swaps are considered to be a foreign exchange transaction and is not required by law to be shown on a company's balance sheet. While currency swaps were originally done to get around exchange controls. Now, about the commodity, um, some traditional examples include grains, gold, beef, oil, and natural gas. More recently, the definition has expanded to include financial products such as foreign currency and indexes. Technological advances have also led to new types of commodities being exchanged in the marketplace, for example, cell phone minutes and bandwidth. But what derivatives has futures got to do with commodities? Well, futures are great way for companies involved in commodities industry to stabilize prices and thus their operation and financial performance. And thank you very much.